So without further ado, I think let's get going. And the first point is just a big thank you to all of you for dialing in. My name's Jack Rose. I'm a strategic sales director at Triple Point. And I'm really pleased to be joined by two of our ventures team, Ian McLennan and Daniel Cardenas-Clark. I've got to remember not to call you DCC today. I'll try and stick to it being formal and Daniel. Just before getting into it, I wondered if you guys just wanted to provide a quick introduction to yourselves.
Yeah, sure. Well, I'll kick off. So for those that don't know me, Ian McLennan, I'm a partner at Triple Point. I've been with Triple Point for over 12 years now. All of that time I've been involved with VCTs, the VCT side of the business. And before that, I had a 20-year career in institutional investment management and research with the likes of Mercury Asset Management and UBS.
Daniel?
Sorry, I feel like I'm talking in space. I can't see myself on the screen. Hi, I'm Daniel. I've been with Triple Point about 5 years. Slightly different career in that my first job was I built a business to about 50 plus staff that was profitable. And I worked in a number of venture-backed fintech startups of varying levels of success. And I joined Triple Point originally to build our first, I guess, customer-facing and tech-enabled product, which was the Triple Point Income Service, which I'm guessing some of you would have used. And then I'm one of the investment team for the VCT.
Perfect. Thank you both. And as I said, thank you to all of you for joining. The aim of today, I'd like to go through this in about 45, 50 minutes, leave ourselves a little bit of time for questions at the end. If you do have questions as we go through, please do pop them into the chat box. We'll do our best to address them as we go through it. Some of you may or may not have dialed into previous webinars on the venture fund. And I know that a number of you are already existing investors on this webinar. So thank you to you for your continued support and welcome to new people on it. The purpose of today, we'll give a very quick introduction to who Triple Point are. We're then going to just recap and overview to our investment strategy. And I think importantly, why we think that is slightly different and unique in the market. And most importantly, I think why it is well positioned to take advantage of the current market situation and why we think it's actually really well placed given the current market conditions. And then just really talking to what we've done over the last 3 years. I think it's a really exciting time for the VCT. Our story has really developed and moved forwards. There's lots of exciting things going on within the portfolio, and Ian and Daniel hopefully are going to talk us through a few of those as we get going. So without further ado, let me get into the body of the presentation. we're going to do it in quite an informal style where we're all going to talk, and have it as a conversation piece. So hopefully that works for everybody. Here's an important information slide from compliance. I'm going to let you read that in your own leisure at a later date. And I think before we talk about the VCT, Ian, and actually this is a slide with regards to a little bit of background to TriplePoint, but I think a better place to start for you and perhaps to provide a bit of a background given your tenure at the business and that you're a partner in the company, just to talk a little bit to people, a background to not just TriplePoint, but if I could ask a second question, beyond the background to TriplePoint and our kind of origins, but also a little bit of a background to the team, the ventures team. And I think what makes us makes you a really strong unit for what you do.
Yeah, okay, Jack. Well, you can see on the left-hand side of that slide there, tiny little dot at the beginning in 2004, TriplePoint was actually launched with a VCT offering. And you'll be able to tell me what number of offering this is, but is it 20?
20
VCT offer.
Yeah.
But just before kind of getting into that, I did also want to emphasize the slide that you moved quickly over, but just to mention, we do always like to consider how our investments impact people and the environment, as well as looking for financial returns for the investors. And just to say, we recently applied to become a B Corporation, which for those who are not aware yet, it's a well-regarded certification for businesses that commit to consider the impact of their investment decisions on communities and workers, as well as on the financial return. So we don't know if we've got it yet, but just to say that is also an important part of our business. So going back to the timeline, the journey for TriplePoint, yes, we started with VCT funds from private investors, and this is showing some of the milestones on the way. But these days we manage 1.8 billion of funds, including from institutional investors as well, and even some funds from the UK government, across a variety of asset classes, infrastructure, social housing we've got in there as a big part of our portfolio, leasing and lending, as well as venture capital. And just to say that start of last week, we announced our intention to list a new digital infrastructure investment trust on the London Stock Exchange. So the point of all of that, I guess, is that we are a broad-based and stable business these days for our investors, that hopefully they can rely on. And on your other point, Jack, which was the team, yeah, there are 5 of us in the venture team. Like to think we've got a fairly diverse background. Daniel's already mentioned his own more operational hands-on background, including at a number of fintechs. We've got Seb, who was a Magic Circle lawyer before he was with TriplePoint. And then, of course, we've got a few grey hair, sort of investment grey hairs on the team with myself and our other 2 colleagues. But also to mention that we did specifically appoint an advisory committee for the venture fund, and those 2 guys are still very much around, 2 entrepreneurs, Charlie Dellingpole and Michael Wood, who help us when we're screening the companies for investment, but also sometimes introduce deals to us as well. And Michael's also got involved in running business strategy sessions for our portfolio companies. So I think, the team plus the advisory committee, we should give investors reassurance that we have a wide range of experience to draw on here.
Yeah, well, I mean, the first point is I wouldn't describe it as grey hair. It would be silvers if you were asking me.
Yeah,
that's much more flattering. And then the second point would be, to the advisory committee, I think it's just worth mentioning, they've both grown incredibly successful businesses themselves, haven't they?
Yeah.
Am I right? Is it Charlie's business that's worth over 500 million? Is that correct? Or am I getting confused with Monty?
No, Charlie's business is the bigger business. I don't know if it's publicly announced as that sort of.
Oh, it is now.
Chat just making announcements left, right, and centre. Oh, good.
It did just take money from one. You can look look it up. Play Advantage raised a fund led, but I think it was
I guess we've made the point before that they both kind of, if you dig out your old Sunday Times Tech Track 100 list, those two guys keep appearing in it.
Yeah, I think that is really, really important. It's not just two entrepreneurs, and they've got real credibility and track record behind them. As you say, the Tech Track top 100, they often appear in. Coming into the offer itself, and just before asking Ian you to recap a little bit on the investment strategy, for those of you that aren't aware, we currently have a £10 million top-up offer for our existing portfolio that we're currently fundraising for. The fundraising is going really, really well. We're closing in on £5 million raised. We're just short of that. So fundraising is going extremely well, and I think is really a credit to, as I said, our story developing, and I think resonating really with advisors in this market about why it's so well placed given the current environment. Our ambition is to or stated objective, I think, is something that again is slightly different from some of our peers. Yes, we're looking to deliver good, consistent long-term income for our investors. Last year we paid a 3p dividend. Next year, I say next year, this summer we're targeting another 3p dividend and looking to grow that over time to 5p. But it's not just about the dividends and the income that we're looking to generate for our investors. We are looking to deliver long-term capital growth in our portfolio as well, which again is something that's slightly different from a VCT perspective. Lots of other VCTs will just try and keep the NAV at a similar price. So keep it there or thereabouts for £1 and pay out everything as income. We're looking to deliver long-term growth alongside the income, which I think marks us out as being slightly different, and I think is a real a unique selling point for us in the market. In terms of investment strategy, I think, Ian, it would be good to bring you in here and just a bit of a recap on the kind of the headline of our investment strategy. What are we looking to do and how are we doing it?
Yeah, so just to touch on three things which I think also make us a bit of a different VCT and a diversifier perhaps for investors who already have a portfolio of more mature VCTs. First, we're totally focused on that business-to-business technology sector, especially software companies. Why? That's where we can use the challenge-led investment approach that we've talked about before, making sure that the products that we invest in are solving real-world business challenges by speaking to the major customers, and in some cases being introduced to the investments by the major customers. And B2B is, from what we said about our team, it's where our team and our advisory committee have strong skills. And our own research on exits in the venture space suggests very much that there are a lot more successful B2B tech exits in UK venture-backed businesses than in the consumer sector. I should also mention that, as a byproduct of the B2B focus, we benefited from not having any direct consumer in the last 12 months when there's been quite a lot of disruption to that sector from COVID. The second point of differentiation would be we're investing earlier stage, I think, than most of our peers. We don't have to write £5 million checks in order to deploy the capital that we've raised. Our average ticket size is around £500,000. So we are very much investing more in what's called the seed stage of the venture capital cycle, which I know that Daniel's going to touch on a little bit more shortly. But it's, the reason that we do that is that we think we're getting in earlier in the valuation cycle. So better valuations, potentially higher returns. This is real venture capital. And then so the third and final point that I'd make at this stage would be that while we are giving investors the kind of the stability of investing in an established VCT that's been around for 9 years, this is a share class that's only been around for 2.5 years. It's a younger share class. We'll talk about where the portfolio is getting to shortly, but already over half of that portfolio has been invested post-COVID, post the advent of COVID. So this is very much an up-to-the-minute portfolio, very up-to-the-minute innovations, no old business models, no kind of old private equity style debt-based business models in here. So those are the kind of key reasons why I think we are we're a diversifier and a growth proposition for the investors, Jay.
I think that last point is a really interesting point before I drag Daniel into this, that, a lot of our investment decisions, as you say, the majority of our portfolio, COVID has been an explicit part of the consideration in making the investment committee paper and the recommendation to invest. We haven't invested into good quality companies that then have had the unforeseen headwinds of COVID. We have looked at these businesses and still see that they are, really credible, exciting opportunities for us and for our investors, in the light of COVID, right? Nodding of head.
Yep.
Daniel, if I can pick on you a little bit and just picking up on what Ian said, which is one of the points that I think marks us out as being different, is the point of where we invest. And specifically that can be typically at an earlier point to many of our perceived peer group, the other VCTs. And it'd just be interesting to know why do you think that that's an advantage? Because I often get people who go, well, why would you go earlier? That's riskier. What's the advantage here in us investing in at a slightly earlier stage? I don't know. Can I pick on you to answer that? You're on mute, unfortunately. The quote 2020,
1 year later, yeah, still doing it. So I guess the obvious advantage, as Ian touched on, is we are paying a lower valuation, and so albeit that comes with higher risk. I think you asked me to mention that, or make it clear that under the state aid rules, it's all early stage and it's all risky. But I think in my opinion, investing at seed stage is much better value than investing at the A stage. Why is that? At seed stage, you're probably paying revenue multiples around 10x. At Series A, the average is 25. So, and in terms of like the actual valuation of the business, not just being lower in absolute terms, but as a revenue multiple of the business, albeit it's a less mature business at that point and carries more risk. But by the time a company gets to from the seed stage to the Series A stage, it's probably gone. The valuation's increased 5x. And you might say, okay, is it worth it for that risk? Well, then if you think about it, if for argument's sake, the business is very successful and Series A achieves a 10x return, whoever invested at the A stage has got a 10x return, we'll have a 50x return. And we think that extra return is worth the extra risk. It's also worth noting that we did some research with Bowhurst, and the average B2B exit from a venture capital backed business is around £80 million. The average valuation at Series A is £25 million. The average valuation at the seed round is sort of 3 to 5. So if you're kind of, I guess, playing statistical data for the market, there's an argument that this investing at the seed stage is much better if you can achieve a mean.
Get better bang for your buck, I guess. The whole venture capital returns with venture capital risk play, you're getting a better proportion of the uplift with where.
Yeah, but also a much higher chance of achieving a on target return, given that the average exit is 80. And I think Ian touched on it, but most of these venture capital trusts aren't really doing venture capital, right? It's kind of investing in less companies with less brand ambitions, if you like. They can still be good businesses.
Yeah, no. I think that does make Ian's point that essentially we're not constrained by the fact that we have to, and I use the word constrained deliberately, that by raising too much money to mean that we have to allocate under the rules, larger checks into companies, which means you naturally have to invest into larger businesses, which means that you ultimately inhibit your ability to really drive those returns that we're looking for in our mandate. Which I guess is where that whole benefit comes from our investors about where we're investing. One of the points that often, it gets levied at me is kind of, how do you mitigate that? How do we address risk here? And that point that actually all investing at under the state aid rules, when companies are less than 7 years from the first commercial sale, is still all young businesses. But I think it's coming on to our next slide and touches on our B2B challenge-led strategy a bit. And perhaps you could talk us through a little bit about how we look to reduce that risk where we can.
Yeah, sure. I mean, so again, looking at some research that was conducted by a couple of third parties, one being CBI Insights, which is a big global market research company in early stage investing in technology. Essentially, if you look at these top 10 reasons, I mean, see nearly half of the reasons there's no market need, i.e. We've built something in our shed and we've brought it out and no one wants it. It's surprising. It's quite a very common issue with companies. Sometimes building for a problem that doesn't exist, and we're always starting with the problem. One of our kind of key facets of our thinking. Can the person articulate what problem they're solving, and does this product actually address that? And so we start with that challenge and try and work backwards. So it involves us speaking to customer or the people that they're working with to kind of develop this product. So we feel that by starting with that problem and validating it via a corporate customer, i.e. they've got someone who's in the process of buying that product, or it's given indications that they're going to buy it because they're working with them on the R&D, mitigates a large chunk of that risk. Additionally, one of the ways we mitigate that risk is by having a very diversified portfolio. So as Ian mentioned, by investing smaller amounts in a greater number of companies rather than, if you like, putting all our eggs in one basket or very few baskets, by having the portfolio invested in just a handful of companies. I mean, currently we've got coming up to 20 now.
Yeah, and I think we're going to come on to talk about where our portfolio is at the moment. As you say, it's really starting to take shape and have a really nice diversification across a number of different sectors, which I think obviously goes to help that. But that underlying point about where we focus in and why we focus on that B2B challenge-led strategy is trying to mitigate that, overwhelming risk that, the majority of businesses fail, or the significant proportion of businesses, I shouldn't say majority because it's 42%, fail because there's no market demand for their product, i.e., as you say, making something in a shed without, quantifying whether there's actually a viable end market. Another question that I have had a lot, especially over the last 6 months, is about investing in VCTs right now, and people going, is this the right time? Why would we back young, smaller companies? Is this surely the riskiest time to be investing into early stage businesses? And I know it's something that you have given me lots of ammunition on previously about this, and perhaps you could talk everybody through why actually you think it's a really good opportunity to be looking at smaller businesses right now.
Yeah, there's a lot of research conducted since World War II that indicates, or not indicates, it's very clear now, that during times of recession or economic uncertainty, more big businesses are formed. We've got nearly 100 years of data to support that now, and just in the last period, which is arguably worse because that period, the session already started 2007, 2009. I think about 19, depending on who's basically look at 19 to 20 unicorns of businesses worth over $1 billion were formed. There's a number of household names in that, like Uber, Twitter, Slack, Groupon, various other companies. So it's actually been, that period was the most productive in our lifetime for forming successful companies. And why is that? There's a number of reasons. People are more willing to take risk when there's higher unemployment. People want to build their own companies and seize their own destiny. In addition to being able to hire better talent, other costs go down, as you're seeing now, as we're all experiencing. Offices are empty, so therefore it's cheaper to rent an office, start a business, or today it's free. You don't need an office, so marketing costs come down as well. other things it just becomes easier and cheaper to operate a business, and there's just more opportunity in that period. So we could see this as the next the next wave of new successful businesses.
Ian, do you have anything to add to that, or is that? Oh,
Is that a buzzer?
Yeah, sorry, that's bad. My phone on silent, but not really on silent enough. Just messages come through. Was there anything to add or not? DCC covered it all off, I think.
I think he's covered it all off, and we're going to talk a little bit about the Kickstart later on, aren't we? So.
Just to say, DCC, your sound is coming in and out a little bit. If I could just get you to kind of shout aggressively at the screen, just to make sure we get that heard. I guess so. Coming onto it, just if now is a really good time to invest in companies, how are we accessing them? What have we been doing to enhance our deal flow? Because I imagine a lot of what you previously did was meet and greets with, it's our professional connection network, which could be quite disrupted by the whole working from home environment. What have we done to, broaden our origination channels?
Yeah, interestingly, it's not been disruptive. If anything, it's more efficient now. We speak to more people. So we're not having to travel to the office.
I'll get back in my box and stop making comments like that. Just
well, I'm saying, if anything, it's better. It's easier to get hold of people and talk to people and spend time with people at the moment. So we're very fortunate. We have a great network of founders and successful entrepreneurs that we work with, not just from our own portfolio or the examples of Charlie Dellimpole and Monty. Michael Wood. But we specifically launched a new campaign to kind of capture this opportunity, if you like. So we call it our Kickstart Fund, which is investing much smaller amounts, £100,000 to £200,000 tickets into smaller, less mature businesses, IP businesses that are just getting going at a much cheaper valuation. So typically sort of anywhere between £1 and £2 million. And we partnered with basically a newspaper to just to get this out there. So rather than the Evening Standard, rather than they were looking to run a campaign called the Spirit of London, addressing how were companies getting back on their feet after lockdown. And we were having a discussion with them. We thought, wouldn't it be great if there's all these new businesses that are kind of reiterating themselves into this new world, how they're retooling, and someone gave them some money to kind of help them get going, because again, they very much understood that times of recession and also times of economic uncertainty, also times of opportunity. So we ran a campaign with them, and I think if you go to the next slide, that would probably help as well.
Yes. Sorry. There we go.
Six guys we work with, so you may recognise or not that those faces. These 6 founders of businesses that are probably household names. So the founder of Gumtree, the founder of Zoopla, LendInvest.
Lots of people might well be familiar with Alex Chesterman, because obviously, especially if you're in the VCT world, not that I like to mention them on our webinars, but there is another well-known household VCT name that had businesses like Zoopla in it, which were obviously founded by and had Alex Chesterman, who is one of these gentlemen, heavily involved with. So that might ring some bells.
Founded it, yeah.
Oh, did it? Again, I don't want to get myself caught out alongside. I know he was heavily involved in it. Yeah,
he founded it, and he's currently founded Cazoo, which is taking on second-hand car sales. Michael next to him founded Gumtree, which I'm sure all of us have sold or bought something from. Christian founded LendInvest, which is a big property lender. Charlie, we mentioned, but Supply Advantage is probably the number one anti-money laundering software for financial institutions. Will's company Phonics powers the charitable donations for I forget what's called, Comic Relief. When you send text messages to donate money, that goes through his company. and Eamon built a company called Onfido, which if any of you have opened a bank account or anything during lockdown, you may have been asked to take your phone and scan a copy of your face or your passport, check your identity. That's his company software. Anyway, but the point is these guys are working with us on the Kickstart opportunities and with the Evening Standard, with the goal of, if we invest in these companies, they may get involved and may invest as well and offer some help and some mentoring. We thought that was a really great story, and as a result, we had hundreds of companies applying during that period once we launched it. That was just great, and we did a number of investments from the process. Kickstart is more just if you like, an origination channel or a PR campaign with a newspaper. It's a strategy within the fund to back earlier businesses in this time.
I think, as you say, I think it's so exciting, a real validation of our investment strategy. It's exactly where the rules for VCTs and EIS should be positioned, and to have 6 of the best known, most successful UK tech entrepreneurs kind of backing what we're doing, I think is a real validation of what we're looking to do with the right types of businesses, and it's incredibly exciting. Ian, just coming back to you, and we mentioned at the beginning, we're almost 3 years into the journey now for the venture fund, and the story has developed and moved forward each year. And I think it, certainly feels this year it's really turned a corner in terms of it's got a real narrative to it now. We can point to some really key moments that investors would look to have confidence, in the portfolio and on our investment strategy. And this is a page of numbers, and I don't know if there's any in particular that you would like to point out that really help to demonstrate that.
Yeah, I think the main thing, as you say, is that the venture fund story is really developing now. And rather than laboring through all these numbers, just to pick a few of them, we've had our first portfolio exit. I think we might talk a little bit more about that later on, but that was nice to have that kind of validation, endorsement of the strategy. We've paid the first dividend, as you mentioned earlier, and plan to pay another this summer. We've nearly got 20, but we've got 19 investments. We'll soon have 20 in the portfolio. So the portfolio is really building nicely. And I hope that investors can see, there's some real potential building here. And I think, as you suggested before, Jack, you can sort of think of investing in VCTs a little bit like investing in a listed company. Only a few people will want to invest kind of day one, but if you want to be involved, you do want to be involved reasonably early to kind of capture the growth from this young portfolio. Lots of the bigger VCTs you might think of more like a sort of FTSE 100 company, which is they're stable maybe, but the growth has happened and they've really become dividend yield plays more than growth stories. So what we think is evolving here is something a bit different. It's a diversified growth proposition.
Yeah, I often talk to people, and again, because quite often people say that this has the look and feel of one of the larger and more successful VCTs on the market at its earlier stages, and one where people really advocate, hugely endorsed it because they got in at a stage where they got big special dividends out of it. That VCT is now at a point that it won't be able to deliver those kind of special dividends. Has become much more of a yield play, delivering a solid yield every year. As you point out there, you want to be in, it's timing that moment where the portfolio is de-risked to a certain extent, and you're going to be able to ride that growth journey as it goes up. And the portfolio matures. And I think, we are at that point now where this portfolio is really starting to, and you showed me those statistics on how many of the companies have, even in the last 2.5 years, moved from kind of seed and pre-seed stages and Series A up from, maybe seed to Series A and our Series A onto Series B. And that's even in the time frame we're talking about now. So it's quite exciting, I think, for people looking at it. As an opportunity, as a diversifier to their other VCT portfolios right now. And the following slide, I think, is just a sector breakdown of our portfolio. obviously people will see there's quite a large exposure to fintech and software as a service. I don't know if you wanted to just draw out why that might be.
Well, I mean, I guess if thinking about Triple Point, we've been backing fintech companies at Triple Point for a long time before the venture fund was around, including in our leasing and lending side, where the team have been quite involved in some of the more famous British fintechs in terms of being involved in their capital structure to some extent for a number of years, and also Daniel's background as well. And our 2 advisory committee members. So we're not targeting fintech per se, but naturally we think it is an area where we have expertise. And software as a service is, of course, kind of the approach that many companies are adopting now. And we do like to see those kind of annual or 2-year license contracts. So it gives companies a slightly more predictable revenue stream. And you can see that without going through them all, but healthcare also, there's a reasonable exposure there. There's a bit of a crossover with the health tech, the digital health businesses, also with our Impact EIS fund, of course.
Yeah, absolutely. And this is obviously a slide of our 19 portfolio companies as it stands, just their logos pulled up. And if I can just, I don't know, Ian, if there's anything you wanted to raise at this stage, but I was going to just ask Daniel to pick out first. I know we went through this yesterday and got a couple of companies, and I think the one that Daniel's going to highlight a couple and then get you to come on and talk about the company that we exited from. But Daniel, I think it was Haydock was first, and if I flick onto that, perhaps just talk everybody through that, and specifically kind of what the business does, what the challenge it's looking to address, why we think it's such an exciting opportunity in the market. I think would be a really good demonstration of our kind of investment strategy and what we're looking to achieve.
Yeah, so without trying not to get read the slide, but I guess the quick summary is lots of clinicians, doctors, physios, dentists, etc. Spend or waste a lot of their day with what are essentially legacy clinical systems that are not user friendly, I guess not efficient, and lead to a lot of time not spent with patients. So Haydock ultimately was trying to how do we make doctors provide doctors with more time so they could spend it serving patients rather than doing admin. But more interestingly, over the course of the last year with the lockdowns, actually the product has been more important as doctors realise that using this legacy, what you call on-premises systems, i.e. the systems that loaded on a server in your office rather than in the cloud like most of the software we all use these days, realised they couldn't operate their clinics from home. And Haydock provides a full suite back office system for medical practitioners, so that everything from scheduling appointments to having video calls to issuing prescriptions, taking payments, storing medical notes, all of that can be done from anywhere with a laptop. And so while Haydock was growing before it continued, this is a big example of a small business being able to benefit from the current environment. I think the usage of their video module went up 11,000% during the first lockdown. Company's grown, I think it's nearly tripled, the revenue tripled in size since we invested about 18 months ago. It's just a really slick, modern solution in a market that desperately needs one, and we're really excited about the opportunity. There's over 150,000 private clinicians just in the UK alone. So the opportunity global is big, particularly in countries where there isn't an NHS and clinicians are effectively private. So we're pretty excited. The business has done well. It's continuing to grow fast or grow at a decent pace. And founders are great. One of the reasons we chose the business, and like any businesses, is team is everything. And here we had 2 really smart guys, ex JP Morgan, Goldman Sachs, who built a business and sold it to Just Eat for a more modest outcome. However, that sort of wet their beak for them to go on to, be motivated to take on a much bigger challenge, which is Haydock, which is ultimately aiming to, change the way doctors and clinicians work with patients going forward.
I can only speak from experience of watching my dad, who's a GP, struggle with their software program through lockdown, and he might as well have been loading stuff with a floppy disk. It literally looked like Windows 95 was being booted up. It was appalling. Like, it was just a complete disaster. So I can speak firsthand to the need for the software.
I think this is an interesting example of a company where initially, when COVID struck, we weren't sure how it was going to impact their business. So there was we were in two minds about whether it was actually going to mean GPs were too busy dealing with managing their GP surgeries during COVID to buy software. But in practice, it has driven an increase in sales because they need to get onto the cloud. Yeah.
I mean, interestingly, Haydock conducted a survey, and most doctors are saying now, and bear in mind this is private, not the NHS, saying they don't want to go back to working from a clinic full time now. It's quite interesting because they feel they can give a better service by seeing patients online.
Yeah, well, I think that's it's a broad change in working practice, isn't it? Beyond just the doctors and clinicians. I think we'll all see a change to that. And coming into, I'm just conscious on time, an example of the kind of business, Daniel, that we might look to invest in at that early stage. You mentioned the Kickstart campaign, and I think this is an example of a business at an earlier stage. Why is this so exciting for you, and why do you think that this is a really good opportunity to be in at where we're at?
Yeah, again, team being the overriding thing. So Sasha and Laz, who are building this company, we were desperately keen to invest in their last business, but as we were negotiating the investment, another company came along and bought it for a multiple of what we were valuing the business at. So these guys are second-time founders. Again, who had a very good outcome in the last, and they feel that this is a much more exciting opportunity than the last business. And again, COVID plays into this, which makes it quite interesting. The problem we have at the moment is with things like GDPR and other regulation becoming protecting data. A lot of companies have sensitive data which is shared between employees or employees to suppliers. It's hard to protect that, and ultimately a lot of these errors are human errors, and let's try to figure out how to create a way to kind of prevent that human error by allowing companies to lock or encrypt certain files in individual emails, and the only way to open them is via the Seal It app, which scans your face using biometric data on your smartphone to open up that file. So imagine if some of you guys, I imagine you have lists of clients or client information. You might send it to a colleague 6 months later. You might put a password on it, and 6 months later you need to open it and you can't remember that password, or your email gets compromised and someone else has access to that file. Well, if that person has your face, they're not going to be able to access that file. So we thought this is particularly interesting, again, as people are working remotely and less of their devices are locked down. And this is a huge market. I mean, this is literally any company that has customer or financial data. So we're extremely excited about this, where this can go.
And this is an example of a business that is at the early stage, and we've invested a small amount in it, and wait and what's the roadmap here? Is it a small amount, see how the concept develops out, wait for Series A or seed stage, go on from there?
Yeah, so this came out of our Kickstart allocation. So we are very much backing, I said two brilliant people with tackling a very big problem, with the view that if things go well, we'll absolutely be doubling down as the company develops and raises more money.
Yeah, really exciting opportunity. It makes perfect sense given the current situation, the amount of sensitive data that you pass, between, as you say, between employees within a company, but also to outside parties, whether, that's client files for recommendations on, particular products, a VCT recommendation, for instance, perhaps, and the pack that you would want to send out to a client, or, information that we might be sending internally with regards to an investment committee paper.
It's particularly exciting, particularly necessary for any regulated markets such as healthcare or financial services.
Yeah, well, you can immediately see the application in those markets. And Ian, coming on to you, as I said, conscious on time, you mentioned earlier we'd sold out of a business perhaps a bit earlier than we'd want, but a great validation of our investment strategy and our thesis. Could you just talk us through a little bit about what Adepto did, how the sale came about, and why we took the route we did in terms of the exit?
Yeah, absolutely. So Adepto was one of our earliest investments in 2019. It's quite a good example as well of a challenge-led investment, because it was actually introduced to us by one of Adepto's own corporate customers. And the challenge that they and others were facing is, how do you efficiently manage your so-called agile workforce, that being consultants, contractors, and part-time workers that form an increasing proportion of the workforce for many big employers like Capita and EY. So traditional HR systems cope well with employees, but big users of contractors like those found that they were often paying to hire the same contractor twice in different parts of the business, or rehiring low-performing consultants in different areas, or failing to rehire high-performing consultants. And so Adepto's software was specifically addressed at that, tracking and rating the agile workforce. And actually both Capita and EY became customers. And then within 6 months of us investing in Adepto, it was bought by a Californian human resources tech business called Degreed. They wanted Adepto to help supercharge their own portfolio. As you say, the exit was a little bit earlier than we'd ideally have liked. But we had the choice at that stage of cash or taking shares in Degreed. We had a good hard look at Degreed and decided that we would rather take the shares than the cash at that stage. We thought our investors would benefit from a bit of portfolio exposure to a fast-growing San Francisco tech company in their British VCT. So Degreed now sits in the portfolio. And while the exit was a little bit earlier than ideal, because Adepto has gone on to grow quite strongly, it was in many ways a validation of what we're doing, because it shows that other tech businesses are interested in the kind of companies that we're investing in.
And I assume it provides quite a natural exit route for us, in the sense of those businesses that do provide a really clear corporate solution for a larger scale corporate. That acquisition model is a really natural route to exit for us.
Yes, they're getting a lot of the B2B exits that Daniel was talking about earlier. Obviously, a lot of them are by bigger software companies in similar service sectors.
I'm conscious on time, and I think at this point I'm just going to take back and start to wrap things up. And I just want to recap where we started off from, which was that we have a £10 million top-up offer out at the moment. The aim of the VCT and the investment strategy is to focus on B2B investments in the tech area, focused on smaller businesses that are solving large-scale corporate challenges for other businesses. We feel that by investing in this early stage nature of businesses, we can deliver a lot more value and upside for our investors, which puts us at a slightly different point to many of our other peer group. And by focusing in on that B2B nature of businesses that are looking to solve corporate challenges, it goes some way to mitigating some of the investment risk of investing at that slightly earlier stage, because we have validation and proof of concept of a business's investment strategy. Our aim is obviously to deliver both not just a really good, attractive income for our investors, but to deliver long-term capital growth. And we really feel that now is a really exciting opportunity to get invested into the VCT for those that haven't already, as to a certain element, we're now closing in on 20 companies within the portfolio. That is, a good level of diversification. We will continue to build that. So, the risk has started to be mitigated, but hopefully we're starting to provide lots of upside potential for our investors coming in at this point. Worth saying, the team, both at Triple Point and also the directors of the VCT, have also personally invested significant sums of their own money in the VCT. And I think that's something that I would highlight as being really important. I like to see that alignment of interest, not just between the board of the VCT, but also the investment team that are running the VCT are investing in the product alongside our investors, giving validation and confidence to that. In terms of deadlines, I think that's important. The offer is open for both tax years, so both the 2020 and 21 tax year, and also the 21-22 tax year. For those people who are looking to invest in this tax year, we are going to close the offer. I know it says the 5th of April on here. That is Easter Monday. Our last allotment date will be the last working day before that. So we will need applications and cleared funds by the 1st of April. And we're going to RNS that very shortly to make sure everyone in the market is aware of it. For everyone on the call, important for you to know. And for anyone looking to invest in the next tax year, the deadline will be July. We are holding an allotment pre-budget on the 2nd of March. So in a little over 2 weeks' time, we will be doing our next allotment. So for anyone that's looking to invest immediately, that's the deadline for our next allotment. And with that, I think I've covered off most points. Daniel, Ian, is there anything else that you would like to add?
No, I think you've got it. We've got the 19 portfolio companies now, looking to build that to over 30 in the next 12 months.
Yeah. Well, I think the last thing for me to both of you is just to thank you for joining. Thank you for providing some insight to the portfolio and what you guys have been doing with regards to it. I think it's super exciting.